Hi, this is Keith Schneider, CEO of MarketCage.com, and it's June 26th, 2022 edition of Market Outlook. So quite an interesting week, a very powerful reversal in all the key indices and in equity markets pretty much across the board. So let's get into it. So first of all, one of the things we had been highlighting, especially last week, is that in terms of the Bollinger Bands, we got outside of the Bollinger Bands in basically all of the key indices on both price and real motion, or in this particular case with the Dow just barely touching the bottom of it. But if you take a look across the board last week or the prior week, you can see that we were basically really touching or outside pretty much across the board. Now the Qs basically were hugging the bottom of the Bollinger Bands, but what's interesting is the market held and came back inside on price, and hence the significant rally this week. So net, we're still in the process of mean reverting. We're not quite overbought, but I do see important resistance overhead, both on price, right? If you take a look at the S&P, you got some pretty good resistance overhead that sort of coincides with this sharply declining 50-day moving average. So hence, what we have is a mean reversion rally, and the trends are still in bear markets, certainly on the daily charts. Now, one thing that's interesting and to certainly pay attention to is that the IWM, which really was foreshadowing the weakness that we've seen in the markets in 2022, is now on a weekly chart trading under the 200-week moving average, and we're just under it. So net, you've got a situation pretty much across the board, certainly with our real motion indicators, that we're basically outside or just hugging the lower end of the Bollinger Bands, despite this strong weekly rally. So it'll be interesting to see. It's going to be important for this IWM to regain its 200-week moving average. That would put all the four key indices above that 200-week. And that's important to note. It's not that often that the markets, certainly in the last 10 to 15 years, have penetrated that 200-week. And one thing you can see, interesting, is that 200-week moving average never got broken in the Qs. So big cap, tech names held up on a longer term basis in 2020 when COVID broke out, and also tested once again but rejected. So we want to see that hold. And just one thing to note, if we do break down under that 200-week moving average in the Qs, that's going to be a big wake-up call to the equities market in general. But right now, nice bounce after an important test or close to touching it over the last several weeks. Okay, now moving on to one key intermarket relationship, which is the S&P versus utilities, that there was a bit of a distortion on the way down. Utilities actually, if you take a look here, were doing well, but then in May completely fell apart. And when that happened, basically including the most of June, is that the S&P actually, even though it was in a worse overall trend in a bear market with the 50 under the 200 and price beneath it, that the S&P on a short-term basis, looking at our triple play indicator here, actually was outperforming. So it was interesting. Well before that massive drop, the S&P started outperforming the utility index and actually showing short-term risk on, which actually was totally incorrect. So the problem with utilities, of course, was twofold. One, the increase in interest rates made the dividend yield on utilities look weak relative to what the S&P yield was in itself. So bottom line was you had that, and also considering all the pressure from energy and inflation also called into question some of the dividend could be in fact canceled or reduced on some of these utility stocks. So net utilities underperformed during a sell-off, highly unusual. At the moment on this rally, S&P holding up nicely, and there is the chance, of course, that utilities continue its bounce and reclaim its 200-day moving average, and that would still be positive overall for the market. Just putting any of these sectors in a more positive mode would be seen as positive for equities overall. So moving on to volume analysis, this is actually putting a damper on my enthusiasm for this rally, because if you take a look, you still have less accumulation days than distribution over the last couple weeks. Now, we did get a couple days of pretty strong movement here. And look, what's interesting also on Friday, look at the NASDAQ. Volume change, it was actually had less volume than the prior day, so it didn't record another accumulation day. Same thing with the Dow. So even though the NASDAQ was up over 3% on the day, pretty remarkable, and the Dow was up 2.6%, didn't get accumulation days. Hence, with this big move up over 5 to 8%, depending on the index you look at, still more distribution days over the last couple weeks, questioning the strength of this rally. Now, taking a look at sector rotation, can't really argue with that this week. Very, very strong. You can see consumer discretionary up over 9% for the week, outperforming the S&P. That's definitely a risk-on type indication. You also have a situation where technology also very, very strong, and the more conservative plays, risk-off type of plays, basically underperformed, only up 5% or so. So you can see money's definitely moved into spec sectors, and we also got an interesting reprieve from energy, which was the only sector down on the week, of course, reducing inflationary expectations with this sell-off. Personally, we're used to trading commodities, and we still believe that there is a super cycle in commodities. The ebb and flow and the volatility is pretty normal here. So this sell-off, we think, might be short-lived, and we do believe things, certainly commodity prices, can still move a lot higher over time. So looking at market hotspots, just again, same theme that we've covered earlier today is you can see corn, energy, oil and gas, natural gas, all down quite a bit on the week, easing those inflationary pressures. But meanwhile, spec sectors, again, consumer discretionary, along with biotech, very, very strong, along with solar power and clean energy. So that was also surprising to see that big bounce as well. But again, what we're seeing here in terms of the rotation and the different areas and different asset classes, inflation backing off, and of course more speculative sectors showing good relative performance to the baseline S&P. All right, well, as you can see, the big picture is we think we've got some more bounce potential left in the market, but there is important overhead resistance not that far from where we're trading now. And in the bigger picture, we do think we're going to get at least another test potentially of the lows or more at some point in the near future. All right, hope this helps. See you next week, and bye for now.